Why did Donald Trump, a president famously known for never backing down, choose to call a truce with China right when the U.S. economy had just recorded negative growth? The answer lies not in weakness, but in a masterstroke of strategy, setting a policy trap to gain control over both the Fed and the market. The 90-day tariff suspension wasn't just a concession, it was a coordinated move to manipulate inflation expectations, paving the way to pressure the Fed into retreat. With tariffs paused, cost pressures ease, and CPI cools in the short term. When that happens, media, markets, and businesses all start chanting in unison. Inflation is down, cut interest rates now. If the Fed follows through, Trump secures exactly what he needs: lower interest rates, right when he plans to inject money into domestic industrial programs. It's something he couldn't fully achieve in his previous term due to Powell's steadfast opposition. Unlike 2019, this time Trump isn't just applying verbal pressure. He's using policy, and more subtly, the market itself to bend the Fed's hand. And the most fascinating part? The market is voluntarily helping him. Within 48 hours of the deal's announcement, the Nasdaq surged over 4%, the S&P 500 nearly 3%, gold cooled, and bond yields dropped, all signs that investors believe the Fed would soon soften. That's the moment Trump can strike again. If the Fed cuts rates, he can reimpose tariffs, this time deeper, broader, and with less market panic. At that point, Trump would control all three pillars of economic power: monetary policy via a compliant Fed, fiscal policy through looser spending, trade policy through tariffs, a position no U.S. president has held since Richard Nixon. With legislative tools like the CHIPS Act and IRA in hand, Trump's administration could ramp up domestic manufacturing, protect strategic industries, withdraw critical supply chains from China, and restructure the economy toward industrial sovereignty. But the central question remains: will the Fed take the bait?